Imagine a currency pair climbing steadily, your position comfortably in the green, until a sudden shock wipes out your stop loss in seconds. Standard technical tools like moving averages or trend lines often fail here because they focus on a single question: which way is the price moving? Relying on direction alone ignores the physical intensity, the stretch of the market's movement. Knowing the eventual destination doesn't matter if market noise triggers your exit before the trend even has a chance to form. Marc Chaikin developed his volatility indicator to navigate high-pressure trading environments where price action alone wasn't enough to filter out the chaos. He built the Chaikin Volatility indicator to measure the sheer intensity of a trend rather than its path. The indicator functions as a diagnostic tool, measuring the internal pressure of a currency pair to reveal the psychological state of other traders. This provides the specific data needed to distinguish between a random price spike and the legitimate start of a profitable move. This diagram shows the core logic. The indicator tracks how the vertical distance between a candlestick's high and low points stretches and compresses over time. By comparing that range to previous days, the tool monitors the specific rate at which market volatility is changing. To ensure a single anomaly doesn't trigger a false signal, an exponential moving average smooths the data, filtering out the outliers. While the default is set to 10 periods, you can dial the sensitivity in. A short period captures quick scalping opportunities, while a longer period provides the clarity needed for swing trading. This smoothing process clears away the daily noise to reveal the true underlying momentum of the market. When the price line crashes while the volatility line violently surges up, you are seeing a climax of panic selling. This surge often signals that the market has reached a bottom, making a sharp reversal imminent. Watch the transition here. The price flattens into a tight range as the volatility line steadily drops toward the bottom of the chart. This phase of consolidation is the quiet before the storm, where the market stores energy for a major breakout. By tracking these movements, you are measuring the collective exhaustion or the stored tension of every trader in the market. Chaikin Volatility has one significant limitation. It tells you the market is moving faster, but it doesn't say if the price is going up or down. The indicator functions like the speedometer in a car, providing a precise reading of your velocity. Because a speedometer can't tell you your heading, you must pair it with a directional tool, like the Relative Strength Index, to provide a compass. This is the golden rule of the strategy: never trade volatility in a vacuum. You can use this to filter your entries. If a directional tool gives a buy signal while the volatility line is flat, the trade lacks the momentum to be profitable. It also helps manage your exits. If you are in a profitable position and volatility suddenly spikes to an extreme high, the market is reaching exhaustion. It's time to tighten your trailing stops. Open your platform and apply the indicator to a 1-hour Euro chart. Look for the moments where volatility surged right before a major trend shift. Once you measure the internal pressure of the market, volatility stops being a source of fear and becomes a data-driven engine for profit.